Okay, first journal entry here, what do we debit and credit? An issuance entry. Where bonds payable will be credited because we're borrowing money and we're definitely getting cash, and is that it? Is it a discount or is it a premium? There's definitely something in the middle, but which one? It should be premium because the price is above 100% of the face value. Okay, so as long as the price is above 100, it's considered a premium because remember that's a percentage. If it's 100, that basically means we're issuing at par in maturity value. That means just 100% of the face value. If it's 108, that means 108% of the face value. So you times 1.08 by the face value of the bond. So there's a premium here on bonds payable, and don't forget premium is an adjunct account. It's not a contra liability account, so it has the same direction as bonds payable. Okay, because basically that means we're borrowing we're borrowing more money compared to the face value of the bond. So face value is $50,000. What is the dollar amount of premium? Well, the price is $50,000 times 1.08. That will give you $54,000. So yes, $54,000 is the cash that we're getting. So the differences will be the premium, $4,000. Okay, so issuance entry will look like this. If we put this into T accounts, you will have bonds payable, $50,000, right-hand side. Premium on bonds payable also, $4,000, credit side. Okay, both dollar amount is the money that we are borrowing at the time when we issue the bond. Okay, again, the reason why it's above face value is because, well, this problem didn't tell you what's the market interest rate, but if there were a market interest rate listed, it definitely is a percentage less than 5%, meaning the company's bonds interest rate is more attractive. Okay, so $54,000 is the dollar amount they're getting at the time of issuance. Premium is $4,000. And remember, we have to do something about this because this we consider as additional money we collect from creditor, from bondholder. Later on, even though we're paying cash interest every half a year, the same as what we paid for discount case, for par case, but this basically reduces interest expense. Okay, so next entry for semi-annual interest. First of all, how do we calculate cash interest? We use the face value, always the face value of the bond, times interest rate is 5%, right? Given to you in the problem, and then times 6/12. So this part here is cash interest that we're paying every half a year. In terms of what is interest, that would be cash interest minus this premium amortized every half a year. Okay, so that'll be $4,000 divided by the lifetime of the bond is 10 years. And since we're doing this every half a year, so that calculation formula is this. Okay, so cash interest part, you see, this is what I wrote here, $50,000 times 5% times half a year. That'll give you $1,250. This is the cash part that we're paying. But it does not equal interest expense because there's premium that we issued in the beginning. So this premium, we think of it as reducing interest expense actually recognized for that year. Okay, so the same as discounts, premium, we slice it into basically the lifetime of the bond. Every half a year, we'll be reducing premium account by $200. And we'll be doing this for 20 times. Okay, so cash interest part will be $1,250. Premium on bonds payable $200. After subtracting $200, what's actually considered an interest expense would be $1,050 every half a year. Okay, so the carrying amount of bond, in the beginning when we issue the bond, the carrying amount would just be basically the dollar amount that we got from bondholder, $54,000. But gradually we'll be reducing the carrying amount because we're reducing $200 every half a year. So the carrying amount will be reduced by 200 every half a year. When it reaches 10 years later, when the bond matures, the carrying amount of the bond would just be $50,000, and then this is also the time when we pay back this $50,000 to creditors. So this works opposite compared to discount case. Discount in the beginning, the carrying amount of the bond will be at a dollar amount lower than face value, and then we gradually increase the carrying amount for a discount case. But for premium, since we're able to borrow more money in the beginning, we gradually reduce this premium considered as interest expense deduction account. Any questions to this? Okay, if I add another question, the third entry, when the bond matures, how do we journalize this? Basically, bonds payable will be reducing that, and what else? Cash by $50,000. Very good, just the face value. So this is the last entry. When the bond matures, it would always look like this. Okay, for bond, all these three cases is very important. First case, issuance at a par and maturity value at face value is easier compared to discount and premium, because in the beginning, we're basically just collecting $50,000, and then we're paying interest based on $50,000 times 5% times every half a year. Cash interest equals to interest expense. That's for the first case, issuance at par. Issuance as discount is the opposite case compared to this one. Basically, we're getting less money than the face value in the beginning. So that money, the portion that we did not get, different from face value, is the part that we consider discount, and that's additional interest that we gave to creditors in terms of borrowing the money. Okay, so in that case, interest expense would be cash interest plus discount. That would be interest expense for a discount case. Now for premium, since we're getting more money in the beginning, this is the part that we did not expect, but we got additional from creditors. We basically consider it every half a year's interest expense not equal to cash interest, but at a dollar amount lower than cash interest. Because this part here, we gradually spread it along the years. Okay, so it's very important to understand all three cases. How do you journalize a three entry? Issuance entry, interest entry. Later on, when company paid back the money, how do you journalize all three entries for all three cases? And also carrying amount of bond. Understand how carrying amount changes. Carrying amount is like the book value of bond. In the beginning, book value is $54,000. After half a year, book value basically is $54,000 minus 200. Okay, after another half a year, you minus another 200 because this part gradually reduces. The reason why we're doing this is because at the end, we're just paying back the face value. Keep in mind this part is very important. Since we're only paying back face value, we have to do something about this premium account or discounts. And this often happens because market interest rate may not be the same as the stated interest rate the company is offering. So oftentimes, market interest rate will be changing on a daily basis. And when company issues bond, there will be cases of discount, there will be cases of premium. And we amortize it every half a year. So later on, when we pay back the bond, we're just paying the face value. Okay, are we good to move on? Kind of. Okay, the last case